The Fed did it again. The 10th consecutive interest rate increase in a little over a year. You know they like to give us some new information every time there's a press conference to make it interesting. Well, this time it is very interesting. So, in this video, I will talk about what happened on Wednesday when Jerome Powell addressed the audience, what he said, and what does that mean for you and your money. So, stay tuned. Hi there, my name is Jaime Shekaivan and I welcome you to my channel, The Foreigner in America, where I teach locals and foreigners everything they need to know about producing money, keeping the money, and multiplying it, specializing in the markets, real estate, and businesses. So if you're someone like myself who loves money and wants to be successful and free, please subscribe to this great channel and hit that bell so you follow up on my 2 weekly videos. Also, check out my blog, Instagram, and social media under the same channel name, and take a look at my book, which is a very solid read for anyone who wants to improve in their life. So I will leave a link below for you to check out. Without further ado, let's begin. The markets expected this to happen, which is a good thing since they did not move much after the announcement. This puts the benchmark rate at 5 to 5.25% and affects how much banks charge each other, but mainly what you care about is how it affects your pockets. And I would explain it in this video, so stay with me. The things that affect people's pockets are inflation, mortgage rates, auto loans, and credit cards. But even if you are in a financial peace and have no mortgage, no car payment, and no credit card payment in your life, there's no way you can dodge inflation. What markets really care is the promise of the Fed to stop raising rates. Remember last time in a previous video I said Jerome came out saying that he was done with the raises. This time he came out saying that a decision on a pause was not made today, which means we don't know if he will stop raising rates or not. And that's not promising news for Americans since we're currently under high inflation. It's very hard to get a job and still extra hard to borrow money for a house, a car, or pay off any credit card debt with today's rates. What scares me is that they said they anticipated some additional policy firming may be appropriate to achieve the 2% goal on inflation. The only way to make policy firmer is to raise rates and lend less money. So, how does this translate to you? Well, if you are not a homeowner as of now, bad luck, because prices are not gonna fall due to a lack of inventory, but rates are going to continue to be in the 6 to 7% rate. All those videos of market crashes in the real estate market, worse than '08, are just not happening unless there's 6 months or more of inventory out there. Since builders slowed down already and people are still buying, we will never get there. The other problem with people wanting a home is the requirements to get a loan. It's just getting stricter and stricter to get money for anything. The debt to income ratio will be applied to the maximum extent. They will take a look at current income and income sources like Dick Tracy, and more Americans will be denied and keep renting. If you want to buy a car, trust me, that's easier because struggling. Prices of cars are falling and you see cars sitting on a lot for 120 days or more. So, if you are in the market for a new car or a used car, make sure you negotiate price down all the time. Never pay sticker price on something sitting 120 days on the lot. What the government is urging the Fed to do is to stop the raises because it will cause a recession, an excessive loss of jobs. The problem is the Fed doesn't want to tell us exactly what's going to happen. They're saying there will be a shallow recession. What exactly is a shallow recession? Is there a recession coming or not? Nobody knows for sure. When banks start falling and other banks buy smaller ones, the Fed takes that into account a lot stronger than people complaining about how expensive houses and cars are. One thing he said that worries me is tighter credit conditions for households and businesses are likely to weigh on economic activity, hiring, and inflation. What this means in normal human words is that it will be extremely difficult to get money from banks, which means less people buying homes, less people buying cars, and more credit card debt. Less hiring means no opportunity to get a better job if you want to change, or God forbid you get laid off, because it will be extremely hard to get a good job. Inflation being high means your salary is not the same as 5 years ago. When someone talks about six figures, meaning 100,000 a year, 5 years ago, that translates into 120 now. The new six figures is not 100, it's now 120K. You should never stop pursuing more money because it's never enough with this inflation. According to ADP, 296,000 jobs were added in the private sector in April, more than economists expected. The problem is getting a job in this market is difficult. Publications on LinkedIn are outdated. Someone can literally apply to 100 jobs with enough experience for each of them and get only 10 responses back and 0 interviews. I'm not saying that it's impossible to land a job today, but it's harder than last year or 5 years ago, and salaries are not increasing. If a job paid 70K in 2019, most likely it's still paying 70K in 2023, although those 70K are now worth 60 with inflation. My personal recommendation for this Fed rate hike and the future shallow recession, whatever that means, are: 1. Save your money. Whatever you do, don't spend money you don't need to spend. $1 in the bank is better than $1 in someone else's hands. Get your food, pay your housing, fill up the tank with gas, and pay your bills and chill. Unless you have excessive cash on hand, then don't splurge on luxuries. It's not the right time. 2. Don't refinance your house or do a HELOC. If you're a seasoned real estate investor, meaning you have done this 100 times, you flip properties, you have a lot of cash in the bank, you have investors lined up to do business with you at any moment, yeah, pooling equity from a property to acquire more is a good thing. But if you're an average American with nothing but some equity on your home, do not even think of touching such juicy and beautiful low rate and this equity you have. The worst thing you can do with stocks or real estate is sell. He who holds the asset the longest always wins. Everything goes up in value if there is not an infinite supply of it. So do not refinance and pool equity from your home and risk losing it and living inside your car. There will be stable times with a 3% rate where you can think of doing this. 3. Don't be stupid with a car. You don't need a $700 or $800 or even $1,000 a month payment on a car. Trust me, even if you don't invest anything, just putting the money under the pillow every month will ensure you that in an emergency you can grab that cash and live for months before getting more money. If a car is $700 a month, it's not $700. You need to add gas, insurance, maintenance, inspection and registration, tolls, car washes, etc. That sounds more like $1,000 a month to me. You don't live in your car. You spend the money on food to nurture your body, a gym to strengthen it, books to acquire knowledge, and a little socializing to have fun. When you go out, you drink and Uber. Why do you want to spend $1,000 a month for a car you cannot use on the weekends because you drink? Think about it. Number 4, always think about money. I'm always thinking about money and food. This makes me take good decisions. I control myself not to eat like a pig and spend like a maniac. If you're never thinking about it, you let loose. Start putting those 2 things into your priority list. Now, what is left to see if Jerome Powell will stop the raises and we can finally get stability in our lives. If the rates stop or even drop a bit, that will cause mortgage rates to fall and more people to buy homes. Prices will go up though, but we will be in the right direction with the economy. Right now, don't rush buying a home, a car, and take care of your credit cards. But remember, take control of your life and take control of your money. Thanks a lot for watching this video. If you enjoyed it and found useful information, give me a like, subscribe, and hit that bell so you don't miss any one of my 2 weekly videos as soon as they come out. So have a great day. Don't lose any money, and I'll see you next time.